You can have more than 4 people. Like,
I'm so hungry, Johnny.
I haven't eaten today.
Me and I are going to dinner after this if you want to come. I don't know if you have something.
No, I've been meeting. These next 2 weeks, or like last week and this week, I have to meet with every single person. So I have like 5 of them a day. It's fine. We just like.
Okay. Okay, folks. I've got these new and different speakers, microphone today. If you see, oh my.
Okay, this kid, like, I feel like we shouldn't.
Okay, so let me start with the same.
Can't type their email.
Folks.
That's literally the only criteria. Being able.
Maxed out. Okay. So let me start with the same 2 questions that I start every class with, at least for the first few weeks. You know the questions are coming, right? I noticed there are 24 people on the orphan group. This is no longer an orphan group. This is an entire home for orphans. Okay. So if you have 24 people on the group, I mean, you should be able to find groups of 4 or 5 in there right away. I'll tell you what I'm not going to do. If you're holding out hope that I'm somehow going to find a home for you, you're going to be waiting a long time. Okay. This is, you know, you got to take some initiative. If there are 24 people, reach out, try to, because they'll tell you what interests they have. So, you know, kind of create your own group. Because I think that you can't hold off on picking a company till you find a group. So find the group and pick a company simultaneously, 2 parallel paths. So how many of you are still not in a group? Let's see if the 25 hands go up. Huh? Who's not in a group yet? It's amazing. All those 25 people not in this room. Okay. Good. Okay. So let me ask you a follow-up question. And this again is a question you've heard before. Who's picked a company to do your evaluation on? If you picked a company, put up your hand. Okay. Good. We're getting closer. I think about half the class has, but I want you, if you haven't picked a company, to pick one as soon as you can. Okay. Third and final question. Remember that capital IQ thing that I sent you last week? If you have no idea what I'm talking about, just act like you do. But how many of you have actually tried to get on capital IQ? Okay. Good. I'm glad a few hands. Here's what I want you to do. If you haven't got on capital IQ, please do. It's amazing. Once you use capital IQ, you're going to find that every other database kind of fades in comparison because it's incredibly complete. It has 46,000 publicly traded companies on it in terms of both company coverage and the amount of data you can get on companies. You know, you can go back and get last 20 years of earnings if you want, or insider holdings for the last 20 years. It's an amazingly complete resource base. So go back and read that email about how to get on Capital IQ and try to get on, because it is going to be very useful for you in the context of your project. But even if it's not just this project, in every class you take in the school. Any questions before we start? So we're talking about risk-free rates. So today we're going to start the test, the start of the class test. I'm going to start with the risk-free rate question. Okay. So let's see how much what I talked about actually stuck. Because here's my question. Let's assume you've been asked to estimate a risk-free rate to use in valuing a Swiss multinational. If it makes you feel better, call it Nestle. Okay. Let's say it gets 10% of its revenues in Switzerland, 30% of its revenues in the EU, 40% of the revenues in the US, and 20% of its revenues in India. So it's all over the world. I've given you the breakdown. I've given you the risk-free rates in Swiss francs, in Indian rupees, in euros, and in US dollars. which risk-free rate would you use in your valuation, right? So I'm going to give you a choice and you tell me which of these choices is the right choice in valuing a Swiss multinational with the breakdown that I've given. A simple average. If you're on Zoom and you haven't muted yourself, please mute yourself. The first is a simple average of the 4 risk-free rates that I gave you. Anybody think that's a good idea? All right, so glad nobody agreed with that. How about a weighted average? That sounds kind of fancy, right? I mean, it's I could use the weights I've given you. What's wrong with using any kind of average when it comes to risk-free rates? Because you're going to get asked this question. I see people do it all the time in DCF. So you go to work for a bank, a consulting firm, somebody's going to come up with this bright idea. Let's take an average risk-free rate, a weighted average. Tell them what's wrong with taking an average of risk-free rates. What's the analogy I used for temperatures? And I said you can't compare temperatures across the world. One is in Celsius and the other is in Fahrenheit. If I took the temperature today in New York in Fahrenheit and took the temperature in Frankfurt in Celsius and added the two numbers and took any kind of average, simple or weighted, what am I going to get? Complete and total junk, right? Because you have two different measurement mechanisms. You cannot average across risk-free rates because they have very different measurement mechanisms. So none of the averages apply. It's not a simple average, not a weighted average. Maybe I should use a Swiss franc rate because it's a Swiss company. A lot of people do this. If I have a Swiss company, I've used Swiss francs. Indian company, Indian rupees, right? So hold that in thought. Maybe I should just use the lowest of the 4 rates. Because didn't we say that was the reasoning for picking the German euro bond rate? In which case my risk-free rate would be the Swiss franc rate, was the lowest of the 4. Maybe I should use the highest of the 4 rates because I want to be conservative. So let's take the lowest and the highest. Do you think I should use the lowest of the 4 rates? Yeah. Does anybody want to agree or disagree with that? The lowest of the 4 rates. If that's my reasoning, every company I should value, I should use the Swiss franc rate as my risk-free rate, right? It's always going to be the lowest. I can't use the lowest or the highest because the reason what's different about this versus the euro example is those were 12 government bonds, all denominated in euros. There, the lowest rate is the risk-free rate, but when I give you 4 different rates in different currencies, you can't pick the lowest rate, you can't pick the highest rate. You can't pick a rate just because it's a Swiss company. So what should I be doing? What drives my choice of risk-free rates?
You would probably choose the one.
Okay, so can I value Nestle in British pounds? Sure. Can I value in Swiss francs? Absolutely. Can I value in euros? Yes. You pick the currency in which you're going to do the valuation. You can pick any of these currencies. And it doesn't even have to be one of the currencies that they're exposed to. My risk-free rate should always be in that currency. I want you to remember that. Risk-free rates don't depend on where the company is incorporated. They don't depend on comparisons across rates. They depend on the currency that you choose to do your valuation. You're saying, what if I have a currency where there's nothing default free? We started examining that with the Brazilian real yesterday or last session. I'm going to come back to it and talk about what if you have the Egyptian pound where you don't even have the ammunition that you have with the Brazilian real? How do you come up with risk-free rates in currencies where there's nothing that you can look at, even as a starting point? So let me move to the second question. Today, we're going to talk about estimating what's called an equity risk premium. Fancy word for what is the price of risk in the equity market? What are investors charging for buying stocks as a premium? I'm going to tell you that the most common way in which people estimate equity risk premiums in practice is by looking backwards. You know why? Because we don't know what stocks will do in the future. So if I ask you, what do you think stocks will make over and above treasury bonds? A logical place to say is, what have they done over the last 50 years, the last 80 years, the last 100 years, or the last 10 years? In the US, we have data going back at least 100 years on this. So let's say you decide that you're going to use whatever you've earned in the past as a proxy for the future. You're making some leaps of faith. They will come back and look at them. But let's say you've decided to go down that road. And you're trying to decide how far back in the past to go to estimate your premium. Should you look at the last year, the last 5 years, the last 10 years, the last 50 years, the last 100 years? So I'll give you the choices. And again, I want you to think purely in terms of, I mean, you might have never seen historical risk premiums before. Think statistically, think in terms of what your job is to estimate future premiums and tell me which one you. I could go just 1 year. You know what the number is going to look like, right? What did stocks do last year? They went up. That was the easy half of the answer. Does anybody know how much they went up by? Yes, let's take the S&P 500. Its return was? It was about 29 with dividends, so 29%. What were T-bond rates last year? 1.5%. What was the risk premium if I look just at last year? 27.5%. If I now insist that that's the premium I'm going to earn every year in the future, you know what's going to look, what I'm going to end up with, right? Nothing is going to look cheap because that's a huge premium because I'll be demanding 30, 40, 50% returns on stock. What's the problem with using 1 year of data? It's just one data point. In fact, I've kind of given away the answer. 5 years, 10 years, even with 10 years, you think it's a long time, but in stock market terms, 10 years is a blink in time. 50 years sounds like a lot, but stock market is not that long. Historical risk premiums, you decide to go there and require a lot of data, which is going to create a problem for us in some markets. Let's assume you're valuing a Vietnamese company. In the US, I said, you have the luxury of going back 100 years, right? I valued a company called Vinamilk. It's a Vietnamese milk dairy company about 3 years ago. You know how many years of historical data you have in Vietnam? If you're lucky, maybe 5 or 6 years. There are many markets where you're lucky to get past 20 or 25 years. Already, you can see one of the problems this is going to create is that when you have some markets, you don't have the choice. At least in the US, can I go back 50 years, 100 years? The answer is statistically, whether you like it or not, you got to go back a really long time period. Because remember, whenever you get a number from the past in statistics, what are you trained to put in brackets below it? To tell the world how uncertain you are. A standard error, right? In statistics classes, you're trained to put this in brackets. My estimate is 3%. And by the way, I need to tell you my standard error is 0.5%, which means my true number can be anywhere from 2 to 4%, plus or minus 2 standard errors. You're going to see the standard errors in historical risk premiums, and it should freak you out. It should cure you of ever wanting to use historical risk premiums in evaluation. Because once you see the range, you say, this is telling me absolutely nothing. Now, another thing about historical risk premiums that I don't like is let's assume 2022 turns out to be an absolutely catastrophic year for stocks. I'm not making any predictions. Don't do anything crazy. Just a hypothetical. Let's say stocks drop 40%. We're in a full-fledged crisis. And I compute historical risk premiums. So the end of 2022, after one of the worst years in history, if I add that number onto my historical data, what is it going to do to my historical risk premium? To add an extra year if it's a really bad year. Just think in pure math terms. So if I add an extra year, it's a really bad year. Oh. Either she was answering the question or she was yelling at somebody. Your historical risk premium is going to go down, right? You're saying, so what? Imagine being in the worst crisis over the last 40-year drop in the market. And you come and ask me, what kind of risk premium should I charge for markets? And I say, you should charge less than you did last year. That makes no sense, right? In the middle of a crisis, you're terrified. When you're terrified, what's your gut telling you? Charge a higher price, not a lower price. Historical risk premiums, I'm going to argue, have two major flaws. One is this big standard error. The second is they actually move in the wrong direction. When you're most scared, they give you a lower number. And when you're feeling really good about stocks, they give you a really, really high number. In other words, the price of risk is moving in the opposite direction as your gut would tell you. Often, though, when I push back on this practice at investment banks or consulting firms, their defense is, what choice do I have? I can't tell you what the premium is going to be. I have to look backwards. I don't think that's true. And I'm going to do one final example to illustrate why. This is going to lay the foundation for a process that I'm going to give you for estimating equity risk premiums that are forward-looking rather than backward-looking. You want to be my guinea pig on this example? It's an easy one. Let's assume that I come to you with an investment. This investment has $1 in cash flows guaranteed every year in perpetuity, in forever. How much would you pay for that investment today? Lead me through the process of first. I told you it was guaranteed, right? It's guaranteed. What kind of investment is it? It's risk-free, right? It's in dollars. Right now, what is a long-term risk-free rate in dollars? If you round it up, maybe 2%. So you got $1 in cash flows guaranteed every year forever with a 2% discount rate. Come on, somebody must remember the present value equations. What kind of cash flow is this? It's a perpetuity, right? And when you have a perpetuity, what's the present value of perpetuity? You take the cash flow, $1, and you divide by 0.02, you come up with $50. So if this were a guaranteed investment, $50. So you're now going to become my guinea pig. So it's $50 you were ready to pay. Now I've changed my mind about the dollar. Instead of it being guaranteed, it's now an expected cash flow. So you're still getting an expected cash flow, but there's uncertainty. It could be 30 cents, it could be $1.70. So let me start with the easy question. On the guaranteed cash flow, you're willing to pay me $50 for the investment, right? On this cash flow, would you pay less or more? Same cash flow, but with risk, right? In fact, it's definitely less. If you paid me $50, I'd be selling you this investment. It'd be the greatest scam in the history of the world because you'd be paying me a guaranteed investment price for something that's not guaranteed. Give me a number. Just make up a number. 30, he said, right? If you give me that price, have you given me your equity risk premium? Because when you make $30, if you pay $30 and you get $1, it's an expected cash flow, what's the rate of return you're going to make every year? 1 divided by 30 is 3.33%. The risk-free rate was 2%. The difference is the premium you're charging. In fact, if he said 20 instead of $30, he'd be demanding a 5% return, right? 1 divided by 20 minus 2% is a 3% risk premium. Do you see where I'm going? You tell me what you pay for something. You've implicitly told me what kind of risk premium you're demanding. It's, of course, messier when you talk about stocks because it's not a guaranteed cash flow. It's not a $1 cash flow, but that's effectively what I'm going to do. I'm going to look at what people pay for stocks. And guess what? If they want to earn a higher premium, you got to pay less upfront. And I'm going to back out from that what the equity risk premium is. I know it sounds abstract, and I'll come back and do this with the S&P 500, but that's the intuition of what I'm trying to do. So you might not tell me what your risk premium is, but if you tell me what you pay for something, implicitly, whether you like it or not, you've given away your risk premium. So let's put that away because, as I said, lots of things to think about. Let's go back to the valuation packet where I left you. So let's review. For a risk-free rate in a currency, if you have an entity that is safe, the Swiss government, the US government, the German government, you can use the government bond rate as your risk-free rate. If you have an entity that is riskier, like the Brazilian government, you got to clean up, right? You take the government bond rate and you take out the default spread. But generally speaking, when people have to value companies in currencies when there is no default-free entity, like Brazil, they get uncomfortable. So I'll give you the 3 ways they try to get around it. First is they try to estimate a risk-free rate in the local currency, which is what now I ended up doing, right? I took the Brazilian government bond, took out the default spread. But you could argue that I'm making a lot of judgment calls. Maybe the default spread is wrong. Maybe the government bond rate can't be trusted. But one is to stay with the local currency and clean up the government bond rate. The second choice is to do your analysis in what are called real terms. In other words, you say, look, I don't want to deal with inflation. I'm going to look for a real risk-free rate, do the analysis in real terms. But I'll give you the third choice because this is what Latin American analysts for the last probably 50 years have used because they don't trust their local currencies. It's getting a little better. There are more local currency valuations. But I remember going to when I first went to Brazil, there wasn't a single valuation I saw, which was a Brazilian real valuation. There were a few valuations in real terms. But you know what the third choice is? Instead of value a company in the local currency, you value it in a different currency. You're actually just shifting your estimation challenge from one number, the risk-free rate, into something else, the exchange rates, but it makes people feel more comfortable. So you're wondering why Brazilian companies and Honduran companies might do their analysis in US dollars. It's not somehow that they've dollarized things. It's because they don't trust their local currency now. That's what I meant when I said currency is a choice. When you sit down to value a Russian company, you're not required to do it in rubles. If you find yourself really stuck on getting a risk-free rate in that currency, you can always value a company in a different currency. Just stay consistent once you made that choice. So let's talk about a couple of things about risk-free rates that I think we need to kind of clean up on. Partly because you're getting a lot of misinformation about risk-free rates. Remember I said, when you ask people, why have rates been low for the last decade? You get the answer because the Fed has kept rates low. You hear this a dozen times every day, right? The Fed's kept rates low. We asked them, why are risk-free rates different in different currencies? They said it's because of risk, which kind of doesn't even make sense because if they're truly risk-free, risk cannot explain it. So I'm going to start with a chart that shows you my estimates of risk-free rates in about 35 currencies. You're saying, why do you stop at 35? These are the 35 where I was able to find a government bond rate. There are only 35 currencies where I'm able to find a government bond rate. And then I'm doing the cleaning up, right? So basically, the height of the column is the government bond rate. The red portion is the default rate. So if you take the Zambian kwacha, the government bond rate is 32%, freakishly high. 7% or so is because of inflation. I'm sorry, because of default risk. You take that out. I have a risk-free rate in Zambian kwacha, 23%. And I've essentially listed out the risk-free rates in different currencies. So you ready for the question? If you can answer this question, you cracked what I call the currency code. You will never have trouble with currencies from this day on when you do valuation. Here's the question. Why do risk-free rates vary across currencies? Notice what I didn't ask. I didn't ask you, why do government bond rates vary across currencies? I asked, why do risk-free rates vary across currencies? Anybody want to give that a try? Because as I said, if you can answer this, you crack the code. Why do risk-free rates vary across currencies? Why is the Zambian kwacha risk-free rate higher than the Turkish lira risk-free rate? Why is the Turkish lira risk-free rate higher than the US dollar risk-free rate? And why is the US dollar risk-free rate higher than the Swiss franc risk-free rate? Nobody want to try? Go ahead. Well, then you're saying the risk-free rates are different because of risk, right? Which means I haven't done a good job. If they're truly risk-free, risk should be gone, right? That was my attempt. Maybe it was ham-handed of bringing in the default spread and cleaning it up because the default spread will be connected to the things you talk about. So if country risk is still explaining it, I haven't done a good enough job cleaning up for it. So if I carry the logical extreme, once I clean up for all the country risk, then the risk-free rates in your world should all converge, right? And they're not going to because there's one factor that you don't control for, which is exchange rate is a symptom of the underlying cause. You're right. The factor that I'm talking about will cause exchange rate risk, but it's not the factor itself. Yes. It is inflation. Inflation is the reason risk-free rate. Let me summarize. High inflation currencies will have high risk-free rates. Low inflation currencies will have low risk-free rates. And deflationary currencies could have what? Negative risk-free rates. So there's the answer to the question that you sometimes get asked. How do risk-free rates turn negative? Because I remember when this first happened 7 years ago or 8 years ago, I was getting this wave of emails from people saying, negative risk-free rates, that can't be true. It can't happen because we've never seen something like that, right? In an econ class, You never see risk-free rates turn negative. So I wrote a post, which I'll send you the link to, basically saying negative risk-free rates, uncommon but not unnatural. Uncommon because it doesn't happen that often, but it can happen if you have enough deflation. And therein lies the reason why currencies don't matter. When you tell people it doesn't matter what currency you value the company in, and they say, but what if I value the company in Zambia and Kwacha? Imagine what your discount rate is going to look like, right? You put in a 24 or 25% risk-free rate, your discount rate is going to be 35, 40%. And what have you been told? High discount rates mean lower value. You know why it doesn't translate into lower value? If you value a company in Zambia and Kwacha, it's true your discount rate is going to be high because inflation is high. But what else is going to be high? Your growth rates are going to be in nominal terms. So even if you're a company that's not growing, you're going to see 30% growth or 25% growth. What one hand gives you, the other hand will take away. What one hand takes away, the other hand will give you. That's why you can value a Zambian company in Zambia and Kwacha. Your risk-free rates will be high, your growth rates will be high, and come up with the value, and value the same Zambian company in US dollars. Your discount rates will be much lower, but solely your growth rates. And you're going to get the same value for the company. So what's going to get you into trouble? Is valuing a company with projected cash flows in Zambia and Kwacha. And then you proceed to discount those cash flows at a US dollar cost of capital. What are you going to find? You're going to overvalue the company or undervalue the company? You're going to overvalue it because in your cash flows, you've now built in a 20% or 25% inflation rate. So your cash flows are growing, but you're discounting them back at a discount rate that reflects a 1 or 2% inflation rate. Conversely, if I take my cash flows in US dollars and use an Indian rupee cost of capital on it, I'm going to undervalue the company because my cash flows have a 1 or 2% inflation rate, and my Indian rupee discount rate might reflect a 5 or 6% inflation rate. Currencies matter because they bring different amounts of inflation into the game, and you have to stay consistent with whatever currency you pick. Any questions? Yes.
So if you wanted to build in future inflation or deflation, would you just do that in later periods?
You can, as long as you adjust your discount rate as well. So let's assume that you believe US inflation is being underestimated. Let's say you believe it's going to go to 5%. When you start the game, you might start at a 1.5% risk-free rate. But guess what? If you truly are right about inflation being 5%, what should happen to your risk-free rate in US dollars over time? It should go up. You have to stay internally consistent. In fact, I'm glad you brought up risk-free rates in the US because, as I said, the consensus or the conventional wisdom is that T-bond rates have been low for the last decade because the Fed did it. But 8 or 9 years ago, I have 4 kids, they're all grown up now, but about 8 or 9 years ago, 2 of my kids were still at home. So one, I think it was Thursday or Friday, they had school off, and I put a really nasty trick on them. I said, let's go to the city for a fun expedition. So they thought they were going to have fun. So we land up in the city, my wife, me, and my 2 youngest kids. They're both in their middle teens, so they're not really small kids. And I take them to the Federal Reserve for a tour. That's actually a great tour. If you've never done it, now, I don't know whether they've stopped because of COVID. Now, they took them to the Federal Reserve for a tour. So basically, this is downtown. So it's right next to the Chase building. It's this big, it looks like a fort. It's a huge building, the Federal Reserve building. You come in and a tour guide takes you as a group through the building. The high point for most people is you go to the mint. You actually see these big stacks of currency. Don't try anything crazy. It's fully protected. But I almost made myself persona non grata right after we entered the building. So as a family, we enter, this tour guide comes up, nice 23-year-old, basically knows a lot about the Fed. And I almost asked her the question that would have banned me for life from my own family. I said, could you please take me to the interest rate room? You know what the interest rate room looks like? Lots of levers. And here's what, at that time, was Ben Bernanke was was in charge of the Fed. Here's what, if you listen to CNBC enough, you're convinced that the Fed chair must be in an interest rate room. And you know what he does? He says, the T-bond rate looks a little low. Let me move the lever up. Or the T-bill rate looks a little high. Because that's the sense you get. The Fed controls all these rates. The truth is there is no interest rate room. You know why? Because the Fed doesn't set T-bond rates. It doesn't set T-bill rates. It doesn't set any interest rate that you or I will ever run into. What's the only rate the Fed sets? It's called the Fed funds rate. In fact, that was the second question I was going to ask. Can you take me to the Fed window so I can borrow the Fed funds rate? Try it out of the Fed. Trust me, they will either arrest you or they will laugh at you. Because the only entities allowed to borrow from that window are banks for overnight borrowing. That's the only rate the Fed sets. So when you hear all this talk about there are 4 rate increases coming up this year or 3 rate increases, think of how much time is wasted on CNBC on those rates. They're talking about changing the Fed funds rate. Now, don't get me wrong, that rate can influence the other market rates, but ultimately the Fed cannot alter a reality. So let me show you a chart and then I'll take the question. What do we say drives interest rates? Expected inflation. In fact, there's this breakdown of interest rates into expected inflation and a real interest rate. That's basically called the Fisher equation. It's just you take a nominal interest rate, there's a real interest rate and expected inflation. Now, the next thing I'm going to say is a little controversial, not everybody agrees with it, but I believe in the long term, this is true, that real interest rate in the long term has to converge on your real growth rate as an economy. In other words, if you have 2% growth over time, your real interest rates have converged on it for a simple reason. If I go around promising people a 2% real interest rate and I'm growing at only 1% in real terms, I'm going to have a problem because remember, when you borrow in real terms, you're agreeing to pay in goods and services next period. And to grow, if I promise 2%, I'm growing only at 1%, who's going to make up the gap? You see where I'm going? Ultimately, interest rates are driven by inflation views and what you believe about long-term real growth in the economy. So here's what I tried, and I'll come back to this chart. I know I'll come to the middle pages, don't worry. I took the inflation rate and the real GDP growth rate every year. So the red portion of the column is the inflation rate. The green is the real growth rate. I added those 2 numbers up. So as an example, if inflation is 2% and real growth is 3%, 2 plus 3 is 5, I said, I'm going to call that my intrinsic risk-free rate because it's really based on fundamentals. And I compared it to the actual T-bond rate. I know it's kind of, I'm pushing at the limits of what I can get away with, but see this black line? That's the actual T-bond rate. The red plus the green put together is my intrinsic risk-free rate. Do you think the two move together? At least over this period, I think the R squared is like 92%. Put simply, when inflation is high and real GDP is high, interest rates are high. When inflation is low and real GDP is low, interest rates are low. When there's a gap that opens up, there's a problem. We're at one of those gaps, right? If you look at where we are right now, if you look at, so either people are expecting inflation to come back down to 1%, or there's something delusional, the bond market and rates have to go up. There's really no middle ground, right? Either rates go up or inflation comes down. But in general, if you look at why rates have been low for the last decade, the answer is simple. It's because we've had a period prior to 2021 of low inflation and low growth. What's low plus low? Low. Right? It's a mathematical reality. I'm not saying the Fed has had no effect. Obviously, the Fed has had an effect, but it's at the margin. The real reason rates have been low for the last decade is we've been in this period of low growth and low inflation. And we're at a cusp now. Because, for a long time, the assumption was this is going to continue for the long term. But 2021 was a reminder that maybe this was an aberration. That is really where we are in the bond market. And what happens in the future is going to determine whether rates go up to 4 or 5%, or what they say. You're saying, what if the Fed wants them to stay? The Fed can't control that. If inflation goes to 4% and people expect it to stay at 4%, nothing, zero that the Fed can do in that. Because think about it as a bond buyer. You buy a bond, if you expect inflation to be 4%, what's the minimum you're going to demand? You're going to demand at least 4%, right? Cover me for inflation. So if somebody says, why are rates low, and they blame the Fed, they're missing the point. The Fed has an effect at the margin, but ultimately what drives rates are inflation and growth. And when people forget that, they do some really stupid thing. I want to pick on a country, or maybe I do want to pick on a country, but take a look at what's happened in Turkey over the last few months. If the definition of insanity is you keep doing the same thing over and over, expecting a different outcome. In Turkey, you're seeing the end result of misunderstanding what drives interest rates and what drives inflation. I mean, just to be specific, the Turkish government, I would put it more specifically, Erdogan, believes that high interest rates cause high inflation. In other words, he's got the causation mixed up. He says high interest rates, so you know what he's doing, right? He's putting pressure on central banks to lower interest rates, because he says if we do that, inflation will come down. And guess what's happening? As they lower interest rates and push out more money, inflation is actually going in the other direction. Okay? So basically what you have is a misunderstanding of fundamentals, but he's not alone. I mean, I've seen US Treasury members and Fed members of the FOMC say things that you look and say, what? That makes no sense at all. Don't assume that just because somebody claims to be a central banker or is a PhD in economics, when it comes to interest rates, that they won't abandon leave of their senses. Or,
but isn't that just basic, like more dollars competing for the same?
Yeah, ultimately, yeah, but but let's be clear. There is a reason, for instance, that people can say it's okay, right? What's the reason given for why inflation in 2021 was just an aberration? You saw this play out all through the year. What was the reason? It was COVID, recovery, and supply chains. The presumption is it's transitory. So they're not saying inflation will stay high and rates will stay low. The presumption is inflation will come down, and that explains the rates. Whether it's true or not, that's an economically defensible reason. But that's a testable thing. If inflation stays high, the supply chain is no longer to be blamed, then what are you going to use as an excuse? You had a question?
Yeah, so not to be like or anything, but what would you say like monetary policy, like buying and selling securities that the Fed?
That's not monetary policy, right? That's basically a way of, that's quantitative easing. Yeah. Right? Basically, the Fed was trying to buy bonds to keep rates low. Yeah. And people talk about the trillions of dollars the Fed has spent. How big is the bond market, It's huge. The Fed can't affect the bond market. It's not big enough to make rates do what it does. So when people say rates have been low because the Fed has been buying bonds, it'll have to buy 100 times more bonds to actually have that much of an impact. It can't be just central bank buying of bonds or selling of bonds that explains rates. It's got to be ultimately the fundamentals, at least up till 2021. We're aligning with the low rates. Yeah.
Wait.
Yeah, I'm sorry, I'll come back. Yeah, go ahead.
So,
yeah.
So what would you say affect? I'm guessing that the Fed funds rate would affect interest rates.
You know why the Fed funds rate? Because the Fed does have information about the economy that you and I don't, right? Yeah. They're able to collect information and each regional Fed collects information, which is proprietary. They don't share that information. So the presumption historically has been when the Fed does something, it must see something in the economy that we don't see. So there's a signal, right? It's not the Fed funds rate going up by itself that's causing other rates to go up. It's a signal that if the Fed funds rates going up, that must mean that the Fed is seeing strength in the economy. So then you have to adjust your bond prices. So no, in fact, I'll send you the link to this post as well. When I wrote about Ben Bernanke after that visit to the Fed, I called him the Wizard of Oz. I called central bankers essentially. Have you ever seen the movie The Wizard of Oz? Okay. Basically, in the movie, the underlying story is, I'm not giving away anything if you have never seen the movie. Now, everybody else has seen the movie, so I'm not feeling sorry for you. In the movie, the movie starts with Dorothy being plucked out of Kansas and dropped into Oz. And she lands on a witch and kills her. So she's facing homicide charges, I think. And she wants to get back to Kansas. That's how the movie starts. It's very traumatic. If you have little kids, don't take them to the movie. Skip the first 10 minutes. The Wicked Witch of the East or the West, one of the witches gets killed. And the entire movie, 3 hours long, it's a really long movie. Here's what Dorothy does. She skips and she never walks through the whole movie on the yellow brick road because she's been told that the answer to all her problems is the Wizard of Oz. So once she gets the Wizard of Oz, he's going to get her to Kansas. And along the way, she picks up a motley crew. The scarecrow, the lion that needs courage, basically a tin man that needs a heart. I forget what. But each of them is told, you go to the Wizard of Oz, he has the answer. And finally, they get to the Wizard of Oz. And it turns out that he has none of the answers. But you know what? They got everything they wanted on the journey, along the journey. The Wizard of Oz had no powers. His power came from the perception that he had power. So everybody thought he had power. And that gave him the power because everybody said he's powerful. See how this applies to central banks? Central banks have very little power. But to the degree that people believe they have power, those signals get very powerful. Which is, so the worst thing you can do as a central banker is to mess with that power. To give you another analogy, I don't know whether you've ever read the story of Chanticleer. Chanticleer was a rooster who lived in a farm. And every morning, Chanticleer got up and crowed and the sun came up. And after a while, the animals all thought that Chanticleer was the one that made the sun come up. He was worshipped, he was leader of, and then one day Chanticleer slept in. His iPhone didn't go up at the right time or whatever it was. And guess what? The sun came up anyway. And the other farmyard animal said, you're not the one making the sun come up. It's going to come up anyway. That is what the central banks have to be careful about. If inflation is coming back, you know what the central bank should do? It should go out and raise rates. And then it can say, look, it's because of us that rates went up. It's kind of the worst thing you can do is fight reality, like the Turkish central bank is doing, because then you lose the credibility. And once you lose that, all your power is gone. So for this year, you're going to see a lot of Fed stories. You're going to see a lot of misconceptions about interest rates. Listen, question, and then put it under the microscope, because many of these stories make absolutely no sense. Yes?
I mean, at least what I've read is that the Fed is trying to focus on like equity and climate change in addition to their like original mandate.
So the Wizard of Oz is now going to extend this manifesto and do things and basically, I mean, let's face it, right? How can a central bank make changes like those? I mean, if you begin with what power do you have? The Fed funds rate is what you're going to use to, because the climate change, it makes absolutely, the only way the Fed potentially could have an effect is to the degree that it can put regulations on bank lending. Maybe that's what they're talking about, is maybe they can say, if you lend to a fossil fuel company, you got to pay 2%, you got to charge 2% more. That would be a dangerous extension of what the Fed has as powers right now. It doesn't have that power right now. But when we have to, there's a lot of stuff that the Fed claims to be able to do. The central bank in any country has one and only one real responsibility, which is what? Preserve your currency. That's really it. Everything else is a side story, right? So when you talk about interest rates and inflation, if you mess with interest rates and inflation goes out of control, and this is why I said exchange rates are a symptom of the problem, not the problem, is if inflation is, out of control and it's zooming, look at what happened to the Turkish lira. The problem in Turkey is not that exchange rates went crazy, it's that inflation and interest rates kind of diverge, and that's causing exchange rates to go haywire. One final point about risk-free rates, and then we will end the discussion. As I said, 6 or 7 years ago, when rates first turned negative, people were freaked out. They said, how can this happen? And the answer is, if you have enough expected deflation and you worry about growth dropping off, rates can turn. It's instructive that the two currencies, or the three currencies where risk-free rates have turned negative and stayed negative are the euro, the Japanese yen, and the Swiss franc. What do they share in common? They all have low or very low inflation historically. And the other thing is, and especially with Japan, which has had the longest history of low rates, What is it about Japan that keeps expectations of future real growth so low? It's demographics, right? It's an aging population. You have an aging population, no matter how you dress this up, this is not good for real growth. So when people talk about negative risk-free rates as a good thing, I say, you're not getting the message here. Negative risk-free rates are not a sign of a healthy, growing economy. Because when you see negative risk-free rates, for better or worse, markets have made a judgment about the long-term future that doesn't look good for this part of the world. So how low can negative risk-free rates go? There's a limit. You know why? Negative risk-free rates are actually very abnormal. In the Netherlands, when you borrow money to buy a house, at today's rates, you know what happens? The bank pays you every month. Because negative interest rates, that's exactly what will happen. Instead of you paying the bank pays you, which is kind of with the principal, basically. But the interest is negative, right? Negative risk-free rates create all these strange things. And in fact, when you go deposit money in a European bank now, not only do they not pay you interest, which is unfair, but they actually charge you for keeping your money in the bank. And this is why there's a flaw. Because at some point, rather than putting your money in the bank and making a minus 2% rate, what are you going to do? Historically, this is why rates were never supposed to turn negative, is you're going to put it in your mattress. That's always been the pushback. Why would people accept negative rates? Well, if you have $1,000 or $500, you can put in your mattress. But what if you have $50 million? Your mattress would have to be really big and really fat. And after you've stuffed your mattress, what else do you have to do?
Why would you turn the money market?
It doesn't matter, right? Because in a sense, nobody's accepting these positive rates. Nobody's giving you 2% in the money market unless you take risk.
But it's better than, no, but I mean, another currency, like IE.
It doesn't, going to another currency is not solving the problem. It's just creating an exchange rate problem, because then you lose an exchange rate devaluation. So here's the problem. If you have lots of money, you can't put in a mattress, because then you got to hire security guards to guard the mattress, and God only knows how much that will cost you. And God help you if somebody breaks into your house and steals your mattress, right? So rates can go negative, but they can't go to minus 10, minus 15% at some point in time. But it does create this side consequence, which is as rates become negative and you start mistrusting currencies, you start to try to hold, right? You say, I don't want to hold the euro, I can't, because remember, every currency has low rates. In fact, if you want a microcosm of why Bitcoin has done what it has over the last decade, there is a portion of the population that's given up on traditional currencies and traditional rates. They think the game is fixed. Whether it's true or not, they've decided to go play the game elsewhere. It is, in a sense, an explanation for why NFTs and cryptos have had such a good decade. It's a side effect of having rates not just be low, but actually turn negative. Because it's a little unfair if you're a saver, if you think about what you're making on your money, because it just doesn't make sense. So we'll actually talk about what to do when you have negative rates, but here's what I don't want you to think about. I don't want you to kind of normalize rates or try to come up with a normal risk-free rate, because it really doesn't make any sense to do that, because it doesn't exist out there. You can't replace today's rate with, hey, I would have liked it to be 3%. I would have as well, but you've got to live in the world you're in. So I know I've given you a lot to think about with risk-free rates, but kind of get past this, a lot of conventional wisdom on it, because there's a lot of misinformation in that conventional wisdom. So let's talk about risk premiums. Let me go back and tell you what the equity risk premium is. It's what you charge over and above the risk-free rate for investing in stocks collectively. So I asked you, what's your equity risk premium? I'm basically saying right now the T-bond rate is 2%. How much more than 2% would I need to offer you for you to invest in US stocks? And I'm going to make it specific, because the premium you might demand for investing in Brazilian stocks might be much larger, but for US stocks. If you say you need to make 7%, 2% is the T-bond rate, 7% is what you need to make. That difference is an equity risk premium. And you can already see why this is going to be a tough number to nail down. There are millions of people in the stock. I can't go around asking each person, And even if I was able to ask every person, God only knows what the answer will actually mean, because you could make up stuff. I'd like to make 50%. Hopes become expectations then. That's why people look backwards. And this is not rocket science. If you ask me what the equity risk premium has been in the US market, I have an answer. In fact, I update it on my website at the start of every year. I go back and I collect returns every year from 1928. That's what my database starts at. In fact, if you wanted, you could go back all the way to 1870. Robert Schiller at Yale has that database. But the data before 1928 is a little messy. There are very few companies, strange things happen. So my database starts in 1928. It goes all the way through the end of 2021. So I update at the end of every year. These are my updated equity risk premiums for the US. Keyword is premiums. I'm giving you multiple potential answers. You're saying, how can there be multiple risk premiums? First, it depends on what period of history I look at. I have 1928 through 2021. That's almost 93 years. I could go back 50 years. I could go back 10 years. And with those 3 slices of history, I get very different premiums. That's the first reason. Depends on the period of history. Second, it depends on whether I compare returns on stocks to returns on T-bills, which are short-term treasuries, or T-bonds, which are long-term. The premium is different when I compare to T-bonds versus T-bills. Second reason. Third is it even depends on how I compute my average. Sounds like a strange thing to say. But if I have 100 years of data, there are 2 ways I can compute the average. I can add up the 100 years of data, the returns each year, and divide by 100. That's a simple average. The other is look at a compounded average. To show you why the 2 numbers will diverge, I'll give you a very simple example. Let's assume you invest $100 in a mutual fund that I run. Next year, your money doubles. You go from 100 to 100. What percentage return did you make that year? Your money doubles. You made 100% return, right? The year after, it halves. So you went from 100 to 200 back to 100, right? So if I asked you, how much money did you make on this fund over 2 years? What's your common sense answer? I had 100 to start, I have 100 to end. I made no money. Through the magic of averaging, I'm going to convince you actually made a 50% or 25% return. And here's why. First year, you went up plus 100%, right? Second year, you have, that's minus 50%. 100 minus 50 is 50. 50 divided by 2 is 25. Don't trust your eyes. You really made a 25% return. For a long time, mutual funds were allowed to report arithmetic averages. It was only in the early 70s that finally the SEC cracked down and said, you can't report arithmetic averages. Nobody makes arithmetic averages because your money compounds. So the second way you compute an average is a geometric average. You look at starting number and the ending number. So if your starting number is 100, your ending number is 100, your return is 0. You can't slice and dice it any better. And then you look at the percentage return you'd have earned with the starting and ending number. So the 3 reasons why my numbers are going to vary is depend on slice of history. It'll depend on T-bills versus T-bonds, arithmetic versus geometric averages. There's my table. See all the black numbers? Those are my estimates of the equity risk premium, depending on how I slice the data, whether I compare to T-bills or to T-bonds, whether I use arithmetic or geometric averages. And already you can see the problem, right? If you're a person who wants to use historical premiums, that number can range, at least based on my numbers at the start of 2022, from 4.47% to 16.5%. Before you get too excited about any of those numbers, they're all crappy. And I'm using the word crappy in a statistical sense. I don't know whether there's another sense you can use it in. But remember I said anytime you make an estimate from past data, you have to estimate a standard error. Let's go back all the way to 1928. That sounds like a lot of data, right? 93 years of data. My geometric average premium for stocks over T-bonds is 5.13%. If you nail me down and you said, give me one number, that's a number I'm most likely to give you as a number from this table, 5.13%. But you know why I would add a caveat to that? The standard error in that number is 2.17%. That's going back 93 years. My standard error is 2.17%. I don't know whether you remember your statistics, but if I give you an estimate of 5.13% and I say the standard error is 2.17%, the way we get a range is you add plus or minus 2 standard errors. Think about doing that. 5.13% plus or minus 2 standard errors will give me an equity risk premium for the US that ranges anywhere from 0.5% at the low end to 10% at the high end. Fat lot of good that does you in valuation, tell you risk premiums will be some number between 0.5% and 10%. And that's with 93 years of data. If I go back only 10 years, take a look at the standard errors. You're getting almost all noise. So when people say, I use the last 10 years of data because I want it to be more current, for a historical risk premium, it doesn't work. You don't have enough data then to make a judgment about your equity risk premium. So I'm going to talk about the limitations of that historical premium, even in the US, which is where you have the most data. The first you saw already, the standard error is large even with 95 years of data or 93 years of data. It's been estimated that you need about 250 to 300 years of uninterrupted stock market data for a historical risk premium to be usable. Good luck with that, right? Well, remember though, market can't change over that period. So if the market changes over the 250 to 300 years, even having the data is not going to do for you. And there's a second problem with using the US, which is what most people use to get risk premiums. You know what the most successful market of the 20th century was? It was the US. I've picked the most successful market and I've extracted a risk premium from it. I'm going to overestimate the premium because the most successful market is going to deliver a higher risk premium than the least successful or the average market. In fact, one way around this is instead of just focusing on the US, you can look at equity risk premiums for other markets. And there is a great database that Credit Suisse maintains at the London Business School, but they have 100 years of data, not just for the US, but for about 30 countries. And across the world, when you look at the average historical premium across these multiple countries, the premium you get is only 3.2%. So even the historical premium that people use as a fact, it depends on first whether you look at just the US, where you get survivorship bias or global. It depends on how you estimate the risk premium and how far back you go. This notion that a historical equity risk premium is a fact should be dispelled. It's an estimate, and it's a very noisy estimate. But even if you, after all of that, you said, look, I still want to use historical risk premium. That's what everybody does. I have a follow-up problem. That works for the US. You can use 90 years of data. That's what you want to use. But what if you have to estimate an equity risk premium for Vietnam, for Brazil, for Honduras, for Zambia? So I'm going to go through a couple of ways you can estimate equity risk premiums for other countries. Because let's face it, you can't do historical premiums for those countries. You don't have enough data. And it's going to be built on something I've already used. Remember how I got a risk-free rate in a currency? I start with a government bond rate, and then I estimated a default spread for that country, right? Either based on a rating or the sovereign CDS market. It's going to come back into play. If you have a base premium for the US, you can then say, look, I'm going to add that default spread on to the equity risk premium I have for the US, and that becomes my equity risk premium for Brazil. This is the state of the art. If you can use those words of how investment banks get equity risk premiums for other countries. They have a base premium for the US. God only knows where they got that from. Maybe they bought it by looking at historical data. Let's say it's 5%. Let's say the default spread for your country is 2%. They just take the default spread, add it onto the US premium, and then dust their hands off. For Brazil, if you remember, I got estimates of the premium that vary depending on whether you use the government bond or whether it's a sovereign CDS spread, or whether I use the rating for the country. And remember then I said be consistent because whatever you pick here is going to come back later. So if you picked a low default spread, you got a higher risk-free rate, but when you come to the risk premium part, I'm adding that lower default spread. So this was last year. My risk premium for the US was 4.24%. I would add the default spread for Brazil. Let's say it's 2.56% to it. And that would give me my equity risk premium for Brazil. So essentially what I'm doing is I'm starting with the US premium and I'm adding the default spread for a country to it to come up with the equity risk premium for the country. I first encountered this about 20 years ago. And it makes some intuitive sense because the default spread captures all kinds of worries about a country. But the problem is it is a default spread, right? It's what you're charging for buying a government bond issued by that country. But what are you thinking about doing? You're not thinking of investing in a government bond, you're investing in a country's equities. So let me ask you a kind of common sense question. If I'm charging 2.56%, that's my default spread for buying a Brazilian government bond, would I charge a larger spread or a smaller spread for buying Brazilian equities? Larger, because equities are riskier than bonds. So this was the question I started with 20 years ago. I said, if I could somehow come up with a way of measuring how risky equities are relative to bonds, I can adjust this 2.56% spread. If equities are 10% more risky, I'll take the 2.56% and raise it by 10%. So how are you going to come up with that measure of risk? I cheated. I let the market tell me how risky government bonds were in Brazil and how risky equities were. I looked up very simply two numbers. I looked up the standard deviation in the Bovespa. Okay? Terribly constructed index, but it's probably the most widely used index in Brazil. I came up with 30%. I looked up the standard deviation, the Brazilian government bond, 18%. Let's do an algebra problem. If I buy the Brazilian government bond with an 18% standard deviation, what am I charging? 2.56%, right? As my default spread. But if I am then, if I'm now looking at, I'm sorry, let's go to this page and I'll come back to the previous. But if I'm now looking at buying equities in Brazil, I'm going to charge an even higher spread. In this case, I'm sorry, let me back up. The standard deviation of the Bovespa is 30%. The standard deviation in the government bond is 20%. Brazilian government bonds are, in this case, if you look at equities, equities are 1.5 times more risky than Brazilian government bonds. I'm just scaling up the 2.56% with an additional risk. Think of that as a melded approach. I'm starting with a default spread, but I'm scaling it up for the fact that equities are riskier. So I've given you two approaches. Approach one, you just take the default spread, add on. Approach three, you take this melded approach. You take the default spread and scale it up. There is a third approach, and that's a middle approach, where you basically don't even look at bonds. You look up standard deviations, but here you look up the standard deviation in the Bovespa and the S&P 500. You see where I'm going now? If the standard deviation in the S&P 500 is 18%, and I'm charging 4.24% as my equity risk premium, if the standard deviation in Brazil is 30%, it must be much higher. I'm just scaling up the US premium for the fact that Brazilian equities are more volatile. This is the approach that Goldman came up with about 20 years ago. And there is one flaw, and I think it's a fatal flaw in this approach. It's built on standard deviations. You know that the standard deviation in the Egyptian index is less than 10%. Sounds absurd, right? Risky country. What drives standard deviation? There's the risk of the country, but to see it as standard deviation, what has to happen in the market?
It has to go up and down a lot.
Or you have to trade, right? If you have no trading in a market, it's an illiquid market, you're going to get a very low standard deviation because if there's no trading, it doesn't show up in prices. Markets like Pakistan or, in this case, if you look at Egypt, much of Africa, you actually get standard deviations in indices that are much lower than the US. You see what that's going to lead you with the Goldman approach, right? I'd be charging a much smaller premium than for Egypt than for the US, which makes absolutely no sense because I'm looking at standard deviations to markets with very different liquidity.
So why do they use it?
Why do they use it? Because it works in some countries and it gives them at least this veneer of, hey, look, we have this approach for adjusting risk premiums. And as long as you're working with countries like Brazil, it works. And their reasoning is how often are you going to run into an Egyptian company or a Pakistani company? So from that perspective, they get away with it when it works. And when it doesn't, they make up crap. Right? They just say, that didn't work. I will use a substitute instead. So let me list out the three approaches. First, you just take the default spread for the country, add it to the US premium, call that the equity risk premium for the country. The second, you take the default spread, scale it up for the fact that equities are riskier than bonds. That's my approach three. The advantage there is if you're in a market that's illiquid, both the bonds and the equities are illiquid. So both numbers tend to go down. And because I'm looking at a ratio, I can get away with it when I use my approach, but Goldman cannot because it's comparing across two markets. The third approach, the Goldman approach, you just take differences in standard deviation equities and you attach different risk premiums. Yes?
Does this give you, like, I don't want to say the word correct, but like, when you think the equity risk premium, say, of the United States, can you do it?
Well, you got to have some base number, right? So it depends on, you have to start with something. If you have to start with nothing, then you can't do any of these numbers. So the question is, what do you want to use as your base number? If you decide to use Europe as your base number, then you can get the US by comparing it to Europe. But you have to decide what your base number is. And for better or worse, the US still has the richest and the deepest and the longest data series on equities. So, but there has to be a base. Without a base, none of this stuff works. So let me talk about how this plays out in equity risk premiums. At the start of every year, I estimate equity risk premiums for every country in the world. You're saying, why would you want to do that? When are you going to value a Zambian company? You know what? I don't need to value a Zambian company. All I have to do is value a company with the revenues in Zambia, and I'm going to get into trouble without knowing what the equity risk premium for that country is. So I'm going to make a statement about equity risk premiums that's again going to go against conventional wisdom. In much of the world, when people value companies, they attach a risk premium for that company based on the country it's in. So if you're an Indian company, you get the Indian equity risk premium. If you're a US company, you get the US equity risk premium. You're saying, what's wrong with that? Is Coca-Cola a US company? It's not a trick question. Of course it is, right? It's headquartered in Atlanta. You know that 60% of Coca-Cola's revenues come from outside the US, and perhaps a third of its revenues come from some of the riskiest parts of the world. If I want to estimate an equity risk premium for Coca-Cola, I would be out of my mind to use a US equity risk premium for Coca-Cola. I should be using an equity risk premium that reflects where Coca-Cola does business, and it's all over the world. To me, that seems like a common sense thing to start with. It's amazing how much pushback I get on that. By the same token, Vale is a Brazilian company, right? But Vale is an iron ore company. It's the largest iron ore mining company in the world. It gets about 70% of its revenues from outside Brazil. I should be bringing that into my equity risk premium. So guess what? We have no way of avoiding this, no matter what company you pick. My guess is your company has revenues in some part of the world, which is risky, and you need to the equity risk premium for that part of the world. So I'll take you through the process of how I estimated equity risk premiums at the start of 2022 for different parts of the world. I started with a US premium of 4.24%. Next session, I'm going to talk about how I came up with the 4.24%, but I'll tell you how I did not. I didn't look backwards. I didn't use any of the numbers on my table. I came up with a forward-looking estimate that I can update every month. Start of 2022, that number is 4.24%. You remember that number, that's going to become the base number. Then I looked across the world, and I did a very sloppy estimate of country risk. I looked up the sovereign ratings for every country that Moody's rates. It's about 130 countries. You know, sovereign ratings go from AAA all the way down to single C. If you are a AAA rated country, and somebody give me some examples of AAA rated countries. You've got Germany, you've got Netherlands. In Asia, there's only one AAA rated country, and it's Singapore. There are no AAA rated countries in Latin America. Australia and New Zealand are AAA rated. There are about 15 countries that are AAA rated. You know what I do? I give them the same risk premium as the US. My logic is they're mature markets, they're all safe markets. You can have different equity risk premiums if your markets are all mature, because then money will move around. So if you're AAA rated, you get a 4.24% premium. If you're not AAA rated, my work is laid out for me, because I now take that rating and I convert into a default spread. Remember how I did this for Brazil? I do this for every rated country. So let's say your default spread as a country is 2%. I adjust that default spread for the fact that equities are riskier. And again, to keep my life simple, rather than doing government bonds and equities in each country, which is almost impossible to do, I compute one number across emerging markets by using two indices. S&P has this index of emerging market equities and an index of emerging market government bonds. And the ratio of the volatilities of those two at the start of 2022 was 1.16. So let me pause right there. If your default spread is 2% and equities are 1.16 times, more volatile than bonds. 1.16 times 2% gives me 2.32%. Add that to the 4.24%. I've got a risk premium for your country. And I do this for every country that has a rating. You're saying, what if my country doesn't have a rating? I'll come back to that. But this is what the world looked like to me at the start of 2022. So let's start easy. US, 4.24%. Why? Because that's my base premium. I computed using a forward-looking estimate. Why does Canada have the same risk premium as the US? I gave away the logic. Which countries have the same risk premium as the US? If you're AAA rated, Canada's AAA rated. You know, would you rather put in North America? This has nothing to do with geography. It's got to do with more with risk. If you're investing in Mexico as if it's like the US and Canada geographically, you're making a horrendously bad mistake. Technically, half the geography probably doesn't fit. Eastern Europe, you'd be amazed at how many people say, how come you put us in Eastern Europe, not in the EU? I'm basically putting you in spots. I'm not consigning you to a heap. I just want to categorize based on risk. Okay? So basically, every country which has a AAA rating, you get 4.24%. But take a look at Latin America, including Mexico. Okay? What's the riskiest country in Latin America? No surprise, there's Venezuela. Equity risk premium of 24.58%. The safest country is Chile, even though that premium has drifted up in the last few months because of political reasons. You can see even within regions, huge divergences in risk premiums. This is the most downloaded data set by far on my website. You'd be amazed at how it gets misused in practice. I've given up on it. I remember the New Zealand Milk Board was using my equity risk premiums to set milk prices for New Zealand farmers. I didn't even know there was a New Zealand Milk Board. So they emailed me saying, we're using your risk premiums to set milk prices for New Zealand farmers, which my reaction was, who are they selling the milk to? Zimbabwe? But they must have had a reason. And I have this little PDF document I send off on this is how I do it. It's not rocket science. And I'll send you the same PDF document because nothing I've described is rocket science. I'm basically building off data. Once in a while, though, you get an email that you don't know how to respond to. I remember an email I got from Lebanon about a decade ago. And he said, it's from a Lebanese business person. And he said, I was valuing my company. He was really pissed off with me because his appraiser had valued his company for him and come up with a really low value. You know why I came up with a really low value? Because my risk premium for Lebanon was really high. And he said, because you had a high risk premium, you gave me a high discount rate and low value. Why do you give us such a high risk premium? Acting as if I was doing some country risk and punishing countries I don't like. I thought about it for a moment and I said, I've got to be careful here and divert the anger away from me. And I said, it's not my fault. Whose fault is it? Why do some countries have high risk premiums in this table? If your rating is in the toilet, guess what's going to happen? Your risk premium is going to be rich. I said, it's not my fault. It's Moody's fault. And that's an honest answer. This is not my judgment. I'm not doing some qualitative assessment based on your rating, which means if your rating is wrong, your risk premium is going to be low. So for God's sakes, whatever country you're from, don't get pissed off at me because I gave you a high risk premium. I know Jamaicans for a while were really pissed off at me. It's not my fault. If you have a bad rating, your risk premium is going to be high. And finally, there are countries which don't have a rating. And for a long time, I didn't estimate equity risk premiums for those countries. Until I got an email about 3 years ago from a Syrian business person. Must be the last guy running a business in Syria before he leaves. And he said, look, I'm running a business in Syria. I need a hurdle rate for my company. I'm looking at your website for an equity risk premium for Syria, and I cannot find it. How come? And I gave him the answer. You know why I didn't have a risk premium for Syria? Because Moody's did not have a sovereign rating for Syria. Why not? I'll tell you I'll set up a scenario and you can see why. Let's assume you get hired by Moody's into their sovereign ratings group. You walk in, first day of work, and your boss says, I have a really exciting opportunity for you. I'd like you to fly to North Korea, do full research so we can come up with a rating. You'd probably quit on the spot, right? There's a reason there are countries without ratings. It's because the ratings agencies is too terrifying. Syria, Sudan, North Korea. And I said, that's why I don't have a risk premium for you, because there's no rating. The guy was pushy. He said, so what do you expect me to do? I said, you have a point. I'm going to try to estimate your equity risk premium. So the last thing is, if you look at the very top, those are called frontier markets. Yemen, Zimbabwe, Sudan, North Korea. I use a score called the Political Risk Services score. It's a numerical score. And here's what I do. Let's suppose I want a risk premium for Syria. Score is 53 or whatever it is. I don't know what the actual score is. 45.5. I look for other countries with roughly the same scores and see if they have ratings. It's very simplistic. And then I attach a risk premium. The end result, though, is no matter where you operate in the world as a company, I can now estimate your equity risk premium. So when I start class on Wednesday, we're going to talk about taking these risk premiums that are at the country level and converting them to equity risk premiums you use for your company. So that's why I want you to pick a company, because then you can bring your geographical breakdown to class on Wednesday and see if you can estimate an equity risk premium.